In 1971, something happened that changed the trajectory of wealth forever, yet 99% of the population has no idea what it was. On that single day, the entire financial system, as we knew it, ceased to exist, and a new game began. A game with different rules, different winners, and different strategies. The people who understood this shift became extraordinarily wealthy. The people who didn't spend the next 50 years wondering why their hard work never translated into real prosperity. And right now, in 2026, we're approaching another inflection point, just as significant and just as invisible to most people. Today, we're going to talk about something that will separate those who build generational wealth from those who watch their savings evaporate. But first, I need you to understand how we got here, because the past doesn't just rhyme with the future. It practically screams the answers at us if we're willing to listen. That day in 1971 was when President Nixon closed the gold window. In simple terms, he severed the link between the US dollar and gold. Before that moment, dollars were backed by something tangible. After that moment, they were backed by nothing but trust and the full faith of the government. Most people didn't notice. They woke up, went to work, bought their groceries, and life seemed normal. But beneath the surface, everything had changed. What happened next was predictable if you understood the machine. Governments could now print money without restraint. And print they did. The money supply exploded. Inflation followed. The people who kept their wealth in cash got destroyed. The people who moved into assets, real estate, stocks, commodities, they multiplied their wealth several times over. Here's what most people miss. This wasn't a one-time event. This was the beginning of a pattern that has repeated itself over and over for the last 5 decades. Every time there's a crisis, every time the economy stumbles, the response is the same. Print more money, lower interest rates, bail out the system. And every single time, the people holding cash get poorer while the people holding assets get richer. Think about 2008. The financial system nearly collapsed. What did the Federal Reserve do? They printed trillions of dollars. They called it quantitative easing, which is just a fancy term for creating money out of thin air. If you were sitting in cash during that period, you got crushed by inflation. If you bought stocks, real estate, even Bitcoin in the years that followed, you made a fortune. Then came 2020. The pandemic hit. The economy shut down. And what happened? The largest money printing experiment in human history. Trillions upon trillions of dollars created in a matter of months. People who understood the pattern moved aggressively into assets. People who didn't sat on the sidelines in cash, watching prices of everything from homes to stocks to groceries skyrocket. Now we're in 2026, and the same machine is running, but the gears are starting to grind. The debt levels are astronomical. Interest payments on government debt are becoming unsustainable. And here's the signal most investors are going to miss. The central banks are trapped. They can't raise rates much higher without causing a debt crisis. They can't lower rates without reigniting inflation. They're stuck between two terrible choices, and history tells us exactly which path they'll take. They'll choose inflation every single time, because inflation is the politically easier option. It's a silent tax that most people don't understand. They see prices going up and they blame businesses, they blame greed, they blame supply chains. They rarely blame the actual source, which is the expansion of the money supply. Let me give you a concrete example. Imagine you have $100,000 in a savings account right now. The bank pays you maybe 1% interest. Sounds safe, right? But if real inflation is running at 5%, you're losing 4% of your purchasing power every single year. In 10 years, that $100,000 will only buy you what $60,000 buys today. You didn't spend it recklessly. You were responsible, you saved, and yet you got poorer. Now imagine instead you took that same 100,000 and put it into a diversified portfolio of productive assets, businesses that generate cash flow, real estate that produces rental income, index funds that track the growth of the economy, even with market volatility. Over that same 10-year period, you're not just keeping pace with inflation, you're beating it. You're actually building wealth. This is the fundamental difference between rich and poor thinking. Poor people ask where their money is safe. Rich people ask where their money can grow faster than the rate of currency debasement. One mindset preserves, the other multiplies. So as we stand here in 2026, looking at the landscape ahead, I want you to understand something fundamental. You have more control over your financial future than you think. Not complete control, nobody has that. But far more than most people realize. You can't control what the Federal Reserve does. You can't control whether we have a recession or inflation or both. You can't control geopolitical events or natural disasters or technological disruptions. But you can control how you respond to these things. You can control where you put your money. You can control your savings rate. You can control whether you educate yourself or remain ignorant. You can control whether you act on principles or emotions. And those choices, made consistently over time, will determine whether you build wealth or struggle financially. It's not about being brilliant. Some of the wealthiest people I know aren't particularly smart in the traditional sense, but they're disciplined, they're patient. They understand a few core principles and they stick to them no matter what. Think about what we've covered today. We talked about how the game changed in 1971 and how it's changing again now. We talked about the trap of holding cash in an inflationary world. We talked about the importance of owning productive assets. We talked about the principles that guide sound investing. We talked about specific actions you can take right now. But none of this matters if you don't act. Knowledge without action is just entertainment. You can watch this video, nod your head, agree with everything I've said, and then do absolutely nothing. And if that's what you do, your financial situation won't change. You'll still be in the same place next year and the year after that, wondering why wealth seems to come so easily to others. Or you can decide that today is the day you take control. Today is the day you stop making excuses. Today is the day you stop waiting for the perfect moment and start working with the moment you have. It doesn't have to be dramatic. You don't need to revolutionize your entire life overnight. Small, consistent actions compound just like money does. Start by saving an extra 5% of your income. Start by opening an investment account if you don't have one. Start by reading one book on investing or economics. Start by having an honest conversation with your spouse or partner about your financial goals. Start somewhere. Just start. Because here's what I know for certain. 10 years from now, you're going to look back at this moment and you're going to either be grateful that you took action or you're going to regret that you didn't. There's no third option. Time moves forward whether you're building wealth or not. The signal for 2026 isn't really about predicting markets or timing crashes. It's about recognizing that we're at a turning point, and turning points create enormous opportunities for those who are prepared. The next decade is going to create a new generation of wealthy people, people who understood the shift from cheap money to expensive money, people who focused on quality when everyone else was chasing growth at any price, people who had the discipline to stick to their principles when it would have been easier to follow the crowd. You can be one of those people. You have everything you need. The information is available. The tools are accessible. The opportunities are there. The only question is whether you'll seize them. I started this video talking about 1971 and how most people missed the significance of that moment. Don't be the person who misses this moment. Don't be the person who understands what's happening but fails to act. Don't be the person who looks back with regret. Be the person who saw the change coming and adjusted. Be the person who built wealth while others made excuses. Be the person who took responsibility for their financial future instead of hoping someone else would solve it for them. The machine keeps running. The cycles keep turning. The opportunities keep presenting themselves. Your job is to understand the machine, recognize the cycles, and position yourself for the opportunities. Everything else is just noise. Thank you for watching. If this resonated with you, take action today, not tomorrow. Today, your future self will thank you for it. Now you've got a portfolio that can handle different economic environments. If growth is strong, your stocks do well. If inflation runs hot, your real estate and commodities protect you. If things get really bad, you've got some bonds and safe havens. You're not trying to predict the future, you're preparing for multiple possible futures. That's intelligent investing, but here's where most people mess it up. They build a decent portfolio and then they panic at the first sign of trouble. The market drops 10% and they sell everything, or worse, they see their neighbor making money on some speculative investment and they abandon their plan to chase returns. Discipline is everything. Having a plan means nothing if you don't stick to it. This brings me back to the 2026 signal I mentioned at the beginning. What we're seeing right now is a fundamental repricing of risk. For years, money was so cheap that investors stopped caring about risk. They chased yield anywhere they could find it. They bought companies with no profits, countries with unsustainable debt, projects with no clear path to profitability. As long as rates were low and money kept flowing, it all worked. But that world is gone. We're now in a world where risk actually matters again, where the difference between a strong balance sheet and a weak one is the difference between survival and bankruptcy, where the difference between a real business and a story is the difference between building wealth and losing everything. The investors who are going to win over the next decade are the ones who can identify quality in this new environment. Not the flashiest companies, not the ones with the best marketing, the ones with real competitive advantages, real cash flows, real ability to navigate tough conditions. These are the businesses that will not only survive, but thrive when the weak players get washed out. And make no mistake, there will be a washing out. There always is when a cycle turns. Companies that looked invincible will struggle. Investments that seemed safe will turn out to be anything but. This isn't pessimism, it's realism. It's understanding that cycles are natural and necessary. They clear out the excesses and create opportunities for those who are prepared. So what should you do right now, today, with this information? Let me give you some concrete steps. First, take an honest look at your current portfolio. Not what you wish it was, what it actually is. How much is in cash losing value to inflation? How much is in speculative bets that only work if everything goes perfectly? How much is in quality assets that can handle stress? Be brutally honest with yourself. Second, stress test your plan. Ask yourself what happens if inflation stays high for the next 5 years? What happens if we have a recession? What happens if interest rates go even higher? If any of these scenarios would devastate your financial position, you're too concentrated in one outcome. You need to rebalance. Third, focus on income generation, not just appreciation. In uncertain times, assets that produce cash flow are worth their weight in gold, dividend-paying stocks, rental properties, businesses that generate profit, These assets give you options. You can reinvest the income, you can live off it, you can use it to buy opportunities when they arise. Appreciation is great when it happens, but income is reliable. Fourth, build your knowledge. The best investment you can make is in your own financial education. Understand how the economy works. Understand how different assets behave in different environments. Understand the basics of accounting so you can evaluate businesses. The more you know, the less dependent you are on others to tell you what to do. And in a world full of conflicting advice and hidden agendas, independence of thought is priceless. Fifth, and this is crucial, increase your savings rate. I don't care how good your investment strategy is, if you're not consistently adding capital, your wealth will grow slowly. The mathematics of compounding are beautiful, but they need fuel. Every dollar you save and invest today is a soldier working for your future self. The more soldiers you have, the bigger your army becomes. Let me share something personal with you. There was a time when I thought the key to wealth was finding the perfect investment, the one stock that would 10 times my money, the one property that would make me rich. I spent years looking for that magic bullet. And you know what I found? It doesn't exist. Or if it does, finding it is pure luck. What actually builds wealth is something far less exciting, but far more reliable. It's consistently saving a portion of your income. It's investing that savings into a diversified portfolio of quality assets. It's being patient enough to let time and compounding do their work. It's avoiding catastrophic mistakes that wipe out years of progress. It's really that simple, and it's really that hard. The hard part isn't the complexity. The hard part is the discipline. It's staying the course when your friends are getting rich quick on crypto. It's continuing to invest when the market is crashing and everyone is screaming that the world is ending. It's being willing to look boring and conservative while others are swinging for the fences. But here's the thing about that boring, conservative approach: over time it wins. Not every year, not every cycle, but over decades it absolutely wins. The people who get rich quick usually get poor just as quickly. The people who get rich slowly tend to stay rich because they built their wealth on a foundation of principles, not luck. Now let me tell you something that might surprise you. The biggest risk you face isn't losing money in the stock market. It isn't a recession or a crash or even a depression. The biggest risk is doing nothing, sitting on the sidelines because you're waiting for certainty, waiting for the perfect moment, waiting for someone to tell you it's safe. That moment never comes. By the time things feel safe, the opportunity has already passed. I learned this lesson the hard way. There was a period in my career where I got too cautious. I saw all the risks. I understood all the problems in the system, and I was right about most of them. But being right didn't make me money. In fact, my caution cost me enormous opportunities because while I was waiting for the crash, assets kept climbing. The people who stayed invested, who kept buying quality assets even when things looked scary, they did incredibly well. This is the paradox of investing. The times when it feels most uncomfortable to buy are often the times when you should be buying. The times when everyone is euphoric and confident are often the times to be cautious. Your emotions are designed to keep you alive in the jungle, not to make you wealthy in markets. Fear and greed are powerful forces, and if you let them drive your decisions, you'll always buy high and sell low. So how do you overcome this? You need a framework. You need principles that guide your decisions regardless of how you feel in the moment. Let me share a few that have served me well. First principle: understand that wealth is built through ownership, not labor. Your time is limited. There are only so many hours you can work, but assets Assets can work for you 24 hours a day, 7 days a week. When you own a piece of a business, that business is generating value while you sleep. When you own real estate, it's appreciating and producing income while you're on vacation. The wealthy understand this instinctively. They trade their labor for assets and then let those assets multiply their wealth. Second principle: inflation is not your friend and it's not going away. I don't care what the official numbers say. If you're paying attention to what things actually cost, housing, food, education, healthcare, you know that your purchasing power is declining every year. This means holding cash is a guaranteed way to get poorer. You need to be in assets that either appreciate faster than inflation or generate income that grows with inflation. Third principle: diversification is your only free lunch in investing. I'm not talking about owning 100 different stocks that all do the same thing. I'm talking about true diversification across asset classes, across geographies, across economic environments. You want some assets that do well when growth is strong. You want some that do well when inflation is high. You want some that hold value when everything else is falling apart. This way, no matter what scenario unfolds, some part of your portfolio is working. Fourth principle: debt is a tool, not a strategy. Used wisely, leverage can amplify returns. Used foolishly, it can wipe you out. The difference is simple. Good debt finances productive assets that generate more income than the cost of the debt. Bad debt finances consumption or speculative bets. Right now, with interest rates higher than they've been in years, the margin for error with debt has shrunk dramatically. Be very careful here. Fifth principle: time horizon matters more than timing. You're never going to consistently time the market. No one can. But you can control your time horizon. If you need money next year, you shouldn't be taking big risks. If you don't need money for 20 years, short-term volatility is irrelevant. The longer your time horizon, the more you can focus on quality assets and let compounding do its magic. Let me give you a specific example of how these principles work together. Imagine you're 40 years old with some savings. You're trying to figure out what to do. You could leave it in cash, but we've already established that's a losing proposition. You could put it all in one hot stock, but that's speculation, not investing. Here's what a thoughtful approach might look like. You take a portion and put it into a low-cost index fund that tracks the entire stock market. This gives you broad exposure to productive businesses. You take another portion and put it into real estate, either directly or through rights, giving you inflation protection and income. You take another portion and put it into inflation-protected bonds, giving you stability. Maybe you even put a small portion into alternative assets like commodities or precious metals as insurance against extreme scenarios. And here's where it gets really interesting. The signal I'm talking about for 2026 isn't about predicting the next stock market crash or timing the perfect entry point. Those are games for speculators, and speculation is just gambling with a nicer name. What I'm talking about is understanding the structural forces that are going to reshape where wealth flows over the next decade. Right now, we're seeing something that hasn't happened in over 40 years. We're seeing the end of the era of cheap money. For decades, interest rates kept falling. Borrowing was essentially free. Companies could borrow billions at near zero rates. Governments financed massive deficits without consequence. Asset prices inflated to levels that made no fundamental sense. But that party is ending, and most people are still dancing like the music is playing. The reality is this: we've built an entire economic system that depends on ever increasing amounts of debt. Consumer debt, corporate debt, government debt. The whole structure is like a tower built on sand, and the only thing holding it up has been the ability to refinance that debt at lower and lower rates. But what happens when rates can't go lower? What happens when the cost of servicing that debt starts consuming everything? Let me paint you a picture. There are companies right now, big companies that you know and trust, that are profitable on paper, but are actually zombies. They only survive because they can roll over their debt cheaply. If interest rates stay elevated, or God forbid go higher, these companies are going to fail. Not because their business model is bad, but because their balance sheet can't handle the new reality. The same thing is happening at the government level. Countries are spending more on interest payments than on education, infrastructure, defense. Think about that. More money going to service old debt than to build the future. This is unsustainable, and when something is unsustainable, it eventually stops. So what's the macro signal? It's this. We're entering a period where the traditional playbook stops working. The strategy of just buying stocks and holding them forever, the strategy of loading up on real estate with maximum leverage, the strategy of assuming central banks will always save the market, these strategies worked brilliantly for the last 40 years, but the conditions that made them work are disappearing. Does that mean you should sell everything and hide under your bed? Absolutely not. That's the worst thing you could do. What it means is you need to think differently about where you allocate capital. You need to focus on quality over quantity. You need businesses with real cash flow, not just growth stories. You need assets that perform in inflationary environments, not just deflationary ones. You need diversification across different economic scenarios, not just different stocks. I'll give you a real example from my own experience. Back in the early 2000s, I watched a lot of smart people load up on tech stocks because they were going up. The story was compelling. The internet was changing everything. These companies were the future. And they were right about the future, but they were wrong about the valuation. When the bubble popped, fortunes evaporated overnight. The people who survived weren't the ones who had the best story. They were the ones who had the best balance sheets and the most disciplined approach to risk. We're in a similar moment now, just with different characters. The stories today are AI, clean energy, crypto, all compelling narratives about the future. And some of them will be right. But being right about the future doesn't mean you'll make money if you overpay in the present. Value still matters. Fundamentals still matter. The price you pay still determines the return you get. Here's what I want you to take away from this. The economy moves in cycles. Always has, always will. There are times to be aggressive and times to be defensive. There are times when leverage is your friend and times when it's your enemy. There are times to chase growth and times to prioritize safety. The investors who build lasting wealth are the ones who can read these cycles and adjust accordingly. Right now, we're transitioning from a cycle that rewarded risk, taking and leverage to a cycle that's going to reward prudence and selectivity. The investors who recognize this early, who adjust their portfolios before everyone else figures it out, they're the ones who will thrive. The ones who keep playing the old game will get hurt.